right, all right, all right. We're going to get started. Can you turn my mic on? Can you turn my mic on? Why? All right, if we can come back together again. If we can come back together. All right, everyone. Hello, hello, hello. All right, so we are live on Zoom and on Facebook. So we're going to get started. It is shockingly loud in here. All right, so we always start with a quote. We're going to get this kicked off because I know we started a couple minutes late, but as the show goes on, here we go. Megan is going to talk knee deep into all of the real estate data, as she always does. We're going to jump into some of the economics, some of the same messaging, some of different messaging, our challenge forward. But as we always start with a quote, we're starting with a quote. The secret of change is to focus all of your energy not on fighting the old, but on building the new. That is Socrates. That is as old as it comes. Stop looking at what you had in 2020 and 2021 and start building 2023 today. Your clients need that as much as you do. It is time to stop focusing on what was, but to continue building the new. So, and I'm going to get excited about talking about the next.
Megan and so trying to keep off around the graph over here. But our pending transaction count ended up increased by about 10.9% from Labor Day weekend to the following weekend. Our pending transaction count from CD versus 1 year ago is down by about 30.9%. So it's indicating a little bit cooler market than what we were experiencing back in 2021. We ended up seeing that there were several, a bump of increase in back on markets, increased week over week by about 30.5%. So if you're seeing more back on market transactions, that is true where properties are falling out of contract and then coming back on the market. But that 30% is going to seem inflated because of any off-market status. So it could have been an expired or a withdrawn transaction and then relisted. So we're starting to see our expired count start to rise as we get deeper into the year. I have a lot of questions that are coming up on a weekly basis. Should I pull my listing from the market now and wait and list until next spring as the market continues to cool off as we get deeper into the year? And it's likely that we're going to probably not have the big, huge run up in 2023 like what we saw back in 2022. Inventory levels are a little bit higher. We're still on pace with where we were back in about 2019, so pre-COVID levels for inventory, but our pending transaction counts have gone down. Now, again, right now, our average household income, the amount of that goes to your principal and interest payments on a monthly basis is sitting at about 42% of your average household income goes to your P&I payments. What happens when we hit about 30% is we start to see appreciation really start to lag. So we might not see that big giant run up of appreciation early in 2023, like what we've experienced for the last 2 years in a row. Again, the last 2 years have been very abnormal in terms of appreciation early in the year. What I'm expecting to see is something more of a return to our normal seasonal cadence pre-COVID-19. When we look at our heat sheets, you can see that the peak months really are March, April, and May for our transactions. So if you have someone that's waiting to list until next year, I would say that our big pickup in the market is probably going to happen around March of next year, rather than seeing that really take off into January and February. Looking at what's happened with our odds of selling. So those of you that have taken your ninja training classes, this is basically where I take into account all of the available listings for sale versus those that go under contract and or close and project that forward for a 4-month period of time or for a month period of time. Now, back in January and February, we peaked out at 87% odds of selling in that given month. That number has now declined and we're now down to about 53.1%. Over Labor Day weekend, that number declined to about 50%. So again, there was a cooling trend that happens over those 3-day holiday weekends. I always tell you, try to avoid listing on these 3-day holiday weekends because you're going to add up and accrue days on market, and you're more likely to have to take price reductions and concessions over those weekends. You also might not want to do an open house on holiday weekends because you won't have the same level of foot traffic coming through those properties as well. Now, again, that number is likely to continue to decline through the end of the year as it historically does. I don't know how much it's going to decline by, but it's going to continue to taper off. So if you're faced with listing now or waiting until next year, we're past our peak selling season. Again, we really peaked out early this year. You may be in better favor if you have the opportunity to wait and list next year. You might get a better price for it by listing it in March, April, or May of next year. Looking at where we are in terms of our active inventory versus what we would need to create a market imbalance. As we put fewer units under contract as we go into the later part of 2022, the amount of inventory that we require to offset demand starts to decline as well. And so based off of that magical 6-month supply of inventory that determines our cutoff between a buyer's market and a seller's market, how much inventory would we need to have in order to create that magical 6-month supply where we have a balanced market? As of right now, we would need to have about 27,000 available homes for sale in our market, whereas right now we still only have about 6,500 units available for sale. This is a good indication that we're not headed into some sort of housing bubble in our marketplace because we're still vastly undersupplied in terms of the amount of inventory that we require. We still only have 24% of the inventory that we require to offset demand. When you couple that with our equity cushion that we had, where we've seen substantial price growth from 2012 through about last year, where we've seen near double-digit appreciation, people have a lot of equity in their homes. So if a homeowner finds themselves in some level of distress, they're able to go through very quickly and sell their home in a very hot market, still a very hot market.
and get out from underneath of that and walk away with all of the equity that they have in that house, unlike what we saw back in the recession of 2008. Also, we would need to have some sort of large jump in unemployment in order for us to go into a more recessionary terms and for our housing market here in Greater Metro Denver. And so unemployment remains at about 3.5 to 3.6%. So we don't have the economic widespread hardship that would cause us to go into some sort of housing recession. Looking at showing activity for the last week, showings came up ever so slightly from Labor Day weekend. Labor Day weekend, there were about 11,000 total showings that were set. And based off of data from this last week, we had about 14,000 showings that were set. So if you're looking at how many showings you should get on a weekly basis, we've gone from 25 shows per property per week back earlier this year in January, February, and March. So now we're looking at about 2 shows per property per week. I'm fielding on Mondays about 5 to 10 phone calls from agents that are panicked. They're calling me and they're saying, Megan, I put up a new listing. I didn't get a single showing on it this weekend. Can you tell me what's going on? And so again, don't panic. The market has slowed substantially. So if you're not getting showings on your first weekend, that doesn't mean that you should go through and make a price reduction your first weekend. Earlier this year, we ended up knowing that if you were on the market for longer than a week with 4 median days on market, that you were likely overpriced because 80% of homes were under contract in the first weekend. It's taking longer to get these homes under contract, and we're looking at about 20 average or 20 median days on market right now for homes to go under contract. So it's taking you longer. So again, I want you to exercise your 3-strike rule before you go through and start making price reductions on your property. Market analysis. And within the target market analysis, you can pull up your zip code and your price range, and you can see how many showings you should have gotten on your property for the last week. It's a great report for you guys to have, and I would highly recommend that you upgrade that or find someone in your brokerage that has the upgraded showing time account so that you can look at that. But widespread market data is showing that about 2 shows per property per week is what you should be getting right now. So if you didn't have 2 showings on your property last week for a listing that you have active, that may be the first indication that you're not getting enough people through the property, and it may be time to consider a price reduction. The second strike is how many showings does it take to go under contract? And based off of data from last week, it took about 13 showings for properties to go under contract. So if we're expecting about 2 shows per property per week, and it takes 13 showings to go under contract, you need to be prepping your sellers that you could be spending 4 to 6 weeks on the market before you go under contract. That makes me skeeve a little bit because I have 2 kids. I have a 5-year-old and a 7-year-old, and I can't imagine keeping all of their toys picked up for a period of 4 to 6 weeks, but it's definitely taking longer to go through and get these properties under contract. We've seen that number jump from 12 showings to go under contract up to 13 showings to go under contract. So we have buyers that are taking their time and looking at a couple more properties before they go under contract before they make the decision. What we're finding is that buyers don't have the same sense of urgency that they did earlier this year, and they're taking their time and looking at more properties before they decide to go under contract. So strike 1, if you didn't get 2 showings on your property last week, that may mean that you're not in your sweet spot in your pricing. Strike 2 is if you've had 13 showings and no offers, you might not be in your sweet spot in the market. Lastly, your third strike is median days on market. Looking at what went under contract last week, median days on market was 18, and that number has actually come down by 2 days in the last 2 to 3 weeks. And so we're seeing them spend just a little bit less time on the market than what we had seen before, but it's still about 18 median days on market for about half of the homes to go under contract. Price reductions for units that went under the contract last week, we saw 44% of them make price reductions. So we're starting to see that number trickle down a little bit, where we're seeing fewer price reductions. About 4 weeks ago, we peaked out. We ended up seeing that about 49% of what went under contract in the last 4 weeks had made price reductions. So we're seeing fewer price reductions happen right now. Typically in the month of August, what we end up seeing is about 22% of homes make price reductions. Again, this last August, it was 41% of what went under contract had made price reductions. So we're off peak pricing again. If you're looking at your comps back from earlier this year, we were looking at nearly a 9.9% decline in what we're looking at for our peak pricing from earlier this year. I took the time to go through and export every closed transaction going back to 2008, and it took me days to go through and pull that information out. But I needed to do a study on concessions because I'm getting a lot of questions on what's happening with seller concessions and how people are using that piece of section 4.2 in your real estate contract right now. And so I went through and I pulled out all of the closed transactions. I made a spreadsheet big enough to crash my computer, which is really exciting for me. And it was wonderful to go through and put all of that information together. But what we're looking at for seller concessions right now is for homes that are in our median price bracket, so between $400,000 to $800,000. It was 45% of them offered seller concessions. Now, also, I went through and I looked at that for homes that were made price reductions, and of that 50%-ish that made price reductions, 50% of them also offered seller concessions. So when I talk to people about what's your strategy in trying to sweeten the deal to get buyers through your property, do I make a seller concession or do I make a price reduction? Oftentimes it was both. And so oftentimes what you want to do is you want to reduce your price so that you can sweeten that property up and get it back out into all of the prospect searches again and have it reping all of your IDX websites. But then in your public remarks field, indicate that you're going to offer a seller concession as well. On average, the seller concession that was offered for those 50% of homes that were between $400,000 and $800,000 was $5,500. And overwhelmingly, what it was being paid towards was for seller points paid down or a buyer incentive. And so 75% of those was what that was going to. And so we're seeing a lot of buy downs right now in our marketplace. Now, the size of price reductions that we saw last week was about a 6.4% price reduction. So they're hefty price reductions that we're making in the market right now, where it's about $45,000 off of the original asking price for people to go under contract. Now, I've gone through and broken this out for you into $500,000 price points. I'll run through this for you super quick so that we stay on track for today. But last week, we saw our month supply of inventory for homes under $500,000 had about 1 month worth of inventory. So that means for every one buyer in the market, they have about one home to choose from. There's been a lot of downward pressure in light of rising interest rates for people to go into this particular market. So this market remains incredibly competitive. It's not close to the 0.1 months worth of inventory or 3 days worth of inventory that we experienced earlier this year, but we are seeing more inventory make its way to market. Our active inventory has actually started to decline earlier this year. Usually in the month of September, we have the most amount of inventory that we do out of any given month in the year, but our active inventory actually started to decline just in the last couple of weeks. So we're seeing fewer new listings making their way to market. Pending transactions week over week went up by about 1.9%, putting about 300 to 400 units under contract in this particular price range. The odds of selling over Labor Day weekend. So again, to show you what happens over Labor Day weekend, when we check the odds of selling, it dropped down to 55.5% odds of selling, but then the weekend directly following Labor Day weekend, it popped back up to 62.1% odds of selling. So again, we see that nice little rebound in the market after everyone took the time off to go camping over Labor Day weekend. Now they've returned back to market and they're looking at homes again. Again, this number is likely to decline as it typically does through the end of the year. In this market alone, for the under $500,000 market, we only had about 1,500 active units available for sale. We would need to be closer to around 9,500 available units for sale for us to get to that magical 6-month supply of inventory for us to shift into more of a buyer's market. Sure, we go through your 3-strike rule next. And so for based off of showing activity from last week, it was about 3 shows per property per week for homes that were under $500,000. So if you didn't get 3 showings on your property for your home under $500,000, that could be strike 1, that you're not priced appropriately. Looking at the number of shows to go under contract, it's stretched out to 13 showings to go under contract. So again, you need to be prepping your sellers. If they're under $500,000, we're looking at about 3 to 4 weeks on the market right now for those units to go under contract. And median days on market fell from 17 median days on market over Labor Day weekend down to 13 median days on market. So it's again about 2 weeks for half of the units to go under contract. Looking at price reductions, it's only 40% of the homes that went under contract last week made price reductions in this particular market. So this market, we're also seeing some more substantial price reductions, and the average price reduction was about 6.4% for units that went under contract last week. In that $500,000 to $1 million price range, where our month supply of inventory dropped from 1.8 months worth of inventory over Labor Day weekend to about 1.6 months worth of inventory just this last weekend. So it fell ever so slightly, indicating a slight rebound following Labor Day weekend. We have about 4,000 active units available for sale, and that number declined by about 2% from where we were over Labor Day weekend. Looking at the odds of selling, we dropped to 47% odds of selling over Labor Day weekend, and we rebounded again following Labor Day weekend. We're up to about 50.7% odds of selling. So again, about half of the homes are likely to sell in the first 30 days. When we're looking at that $500,000 to $1 million price point. In this price range, we had about 4,000 available units for sale, and to get to a market imbalance, we would need to be up to about 15,000 units available for sale. So we still only have about 26.2% of the inventory that we require to offset demand. We're looking at about 2 shows per property per week. So again, you should have had 2 showings on any new listing that you put up between 500 to $1 million. And we're still looking at about 13 showings to go under contract at the $500,000 to $1 million price range. So be prepping your sellers for approximately 4 to 6 weeks on market before you go under contract. Median days on market held fast. We're looking at about 3 weeks right now for homes between $500,000 to $1 million to go under contract, for about 50% of those homes to go under contract. And based off of data from last week for price reductions in $500,000 to $1 million, we were looking at 47.6% of them made price reductions. Your average price reduction in this price range was about 6.3%. As we go over $1 million, the interesting thing is the over $1 million price point is seeing a lot of action right now. And I don't know exactly why that's happening. They may be less interest rate sensitive, more cash heavy in this particular market. But once we go over $1 million, there's been some really sensational numbers that have come through in that market that have kept that market still churning. In this market, we have about 1.9 months worth of inventory, or for every 1 buyer in the market, they have 2 homes to choose from. Our odds of selling was about 48.4%, and that number has been relatively unchanged for the last 6 weeks, where we're sitting at about 50%. In this market, we only have 526 active units available for sale. To create a 6-month supply of inventory, we should be sitting at around 2,545 units available for sale. So we only have 20.7% of the inventory required to offset demand. So this market is more constrained than what we're looking at for homes that are under $1 million, which was really interesting for me to see. We're still looking at about 2 shows per property per week in this particular market. And it was taking about 16 showings to go under contract. So you need to be prepping your sellers for about 8 weeks on the market based off of the number of shows per property per week. Like last week, our median days on market dropped drastically. There is a pool of buyers that are out there waiting for homes to hit the market between $1 and $1.5 million. And last week, the median days on market dropped down to 6 median days on market. We peaked out a couple weeks ago, back when kids went back to school, we were at 28 median days on market. So there's this whole pool of potential buyers that are sitting out there that are waiting for listings to hit the market between $1 to $1.5 million. And if you have a great home in a great location, they're being snapped up very quickly in this particular price range. We only saw that 32% of them made price reductions to go under contract last week. And the average price reduction was about 7.2%, or about $100,000 off of the original asking price. Last price range that we'll talk about, and then I'll turn it over to Nicole for her market update, is $1.5 to $2 million. We're now sitting at about 2.3 months worth of inventory. For every 1 buyer in the market, they have about 2.3 homes to choose from. Our active inventory increased ever so slightly, where we saw a 2.1% increase in our active count. Looking at our pending transactions, they actually increased by about 5.6% this last weekend, or we put about 19 units under contract between $1.5 to $2 million. The odds of selling is still holding fast at about 41.7% odds of selling in this given month. Based off of data for this price range, we only have 193 active listings available for sale. We should be closer to 1,000 units available for sale in order to create a 6-month supply of inventory. This market only has 19.5% of the inventory required to offset demand. Based off of data from last week for showings that were set, we're looking at about 1.6 shows per property per week in this price range, or about 16.3 showings to go under contract. So it's taking a little bit longer in order to get people through these houses. Median days on market dropped by a significant amount going into this last weekend. We're sitting at about 17 median days on market for homes between $1.5 to $2 million. And about 35% of them made price reductions, with about a 6% price reduction on average for this particular price range. I don't feel like I took a breath during that entire time. I'm really amped up on coffee this morning. I got up Nicole Rueth early this morning, is what happened. Are there any specific questions out there that I can answer for you? Yes.
So we have one from Zoom. You mentioned a showing time report. Somebody was wondering if you could restate that
Yes,
report.
so the question was, what report in showing time should I be looking for? So you have to go into the showing time website, so showingtime.com. You have to have the upgraded account in order to pull this report. But from showingtime.com, you go to reports, and it's called target market analysis. You can enter in a zip code and a price range, and you can see how many showings per property per week you should be getting based off of data from that report. I would also highly encourage you to leverage the information of the agents that are also listed in your neighborhood by reaching out to them and seeing what their showing traffic looks like, if they're getting lots of showings, if they're not getting lots of showings, if things have started to lag. But we all need to rely on each other right now in order to get some of that best process data. But again, that target market analysis in showing time report, I end up pulling 5 to 10 of those every Monday for those listings that didn't go under contract the first weekend that they were listed, just to give people a sense or an idea of how many showings they should have gotten. So if you need help getting that report, you're welcome to email me, and I'm happy to pull that for you. Any other questions? Awesome. Well, let's turn it over to Nicole, and thank you guys for having me.
Switch around the presentations. For those of us watching on Zoom and Facebook, they didn't have audio for the first 5 or 10 minutes. I'm gonna beg Megan to do like a little selfie to cover the overall. So you guys got it. Megan, as you go.
Oh, you gotta show up.
Why you gotta show up? In everything that we do, gotta show up. I love that. All right, so I'm gonna let Peter kick off the presentation. While we do that, we kicked off with a quote. Really quickly, I want to let you guys know that we finally got the lineup for the next big thing finalized. If you guys have not seen that, the announcement, it is a very, very packed one day. So we went a little bit of a different route. Instead of going with one really big, really expensive keynote, we pulled in a ton of talent. So we've got Tristan, who started Lab Coat Agents. If you guys know, that started as a Facebook group and is now a coaching program across the country. We've got Renee Rodriguez, who's got an incredible 2-day event called Amplify. He's going to be bringing it. You talk about watching the best speaker you've ever seen on stage. Renee is it. So you need to make sure that we're watching him. We're also, the keynote this year is Molly Bloom, Molly's Game. So a writer, screenwriter, local to Colorado. So you guys make sure to get online and get tickets. If you bought tickets at last year's event, you paid the cheapest price there will be. There will be no coupon codes this year. It's $455. It'll include food, parking, downtown. So made it super close, included parking. You guys, it's probably gonna be the best day that you're gonna kick off the year. All right.
Valet parking.
We're not doing this thing yet.
Valet parking. So even if it snows,
All right.
you don't have to worry about it. February 2nd.
Sorry, I tell a joke, but I'm not good at it. Megan, tell a joke. My favorite. I got no jokes. We'll get this going in just a second. But as you know, Bob kind of alluded to what's happening in the economy. Interestingly enough, and I'll just kind of jump in. We are seeing the Fed is taking serious action because the economy is still moving forward. All right, let's get it. We're going back on. Okay. So the 30-year fixed hits a record high again, right? So 14-year high, Patty talked about this, 6.3%. And a lot of times I talk about the fact that it's not the number, it's the speed by which. It was just a year ago, interest rates were 3, now 6.3. So that's a really extreme number. And a lot of people say, and I've even said, that historically 6% is not an awful interest rate. Yes, 6% with a 44% increase in home prices over the last 2 years is an awful interest rate, right? You add the two together and you get affordability issues. But when I just look at the interest rate, I'm still going to stand up and say it's not a bad interest rate. In fact, historically, we should be around 5 to 6%. We should never, ever, ever have seen 2.6. On the market. And that spurred up home prices. And so now we've got this thing where we're not seeing enough new listings. We're going to continue to have supply constraints. We're going to go into 2023 landlocked on inventory. Yet at some point, we are going to hit the recession. The recession will be notated. Interest rates will drop, and we're going to have an excess demand on limited inventory. That's going to happen. Right now, though, buyers have this open window of getting in when affordability is low. And it is true. It does hurt. And it's not because of the interest rate, but because of the speed by which. So I don't have my mouse anymore. We're having all that. Here we go. All right, there we go. So the Fed hikes. So I want to go backwards just a minute because it's really important that you tell the story. So the Fed is coming out with its announcements right now of pain, but you have to put it into context. And that's why I went backwards. So if I go to July 27th, the Fed came out saying that we're going to try and do a soft landing. We're going to raise the Fed rate. We're going to probably drop it down again, right? So it's going to be up there and then we're going to come back down and everything's going to be okay because we're going to have a soft landing, right? He came out saying that kind of thing. So then, of course, the stocks rally because the stocks like to hear that saying, oh, wait, awesome. We're going to control inflation in a matter of minutes. We're going to get back to business as usual, and I'm going to pick up the pennies. So this is good news for everybody. The stocks rallied, the bonds dropped, our interest rates dropped. We had a field day. There was a minute there that I locked in interest rates at 4.5 to 4.25. I was like on fire, and then it was gone. If I called you that day and you didn't call me right back, you didn't get it. I'm sorry. It happens that way, which is why, like, whenever we see the interest rates go, I'm not a big interest rate, like, especially a Fairway mortgage, which I'm not, that we call that the F word now. So now that we've been One Trust, that we have not been known in the past to be our best in rates. One Trust is absolutely more aggressive and a lot of other things, which I'm going to talk about here in a minute. Fairway's a fantastic company. I'm not going to go negative for anybody that's putting this on social. No, but Fairway's, where we're going with this is the fact that I don't chase rates. That's really the bottom line. I don't chase rates. I'm not going to call up your clients every time. But if I see the rates drop and I go live or I can start calling people, it's because we have so much volatility right now. We do have to take opportunities for when those clients are actively shopping and or looking at interest rates. So we saw the stock market rally. We saw the interest rates drop. Powell then on August 26th, we even saw the CPI come out and it was better than expected. So we saw all this happening and it's like, okay, we hit the top. Inflation's going to start coming down. Powell then is like, whoa, stock market rallied, the interest rates dropped. I don't need us to be that good yet. We're not there yet. So instead of talking about the fact that we're going to raise the Fed rate, we're going to drop it back down again, now he's talking about the fact that we're going to see pain. If any of you guys heard any of the lives that I was talking about this, there was an 8-minute conversation that happened after the last time that Powell came out talking about what was going to happen. This was right after Jackson Hole. So he came out for 8 minutes talking about the pain that was going to get inflicted on households and businesses. Because forget the soft landing, it isn't gonna happen. I'm sorry, but we need pain. And if you're a self-employed household, you're really screwed. Right? So the pain that needed to be inflicted has to control, because as Patty said, consumer spending is 70% of GDP. Stop spending. Now, Patty will say, go on, live your life. I'm gonna tell you to stay home. Just for the love of God, if you stop spending for a minute, slow down so that we can get into the recession, we can all move on with our lives. Just like take a sabbatical, right? Like 30 days. Just like hang back, just hang out, drink tequila, bourbon, whatever. I'm good with it. I drink tequila. So all of this was happening. So but Powell realized that I can't just be that quick. We need to have this be long-term. So it's like, we're gonna raise the Fed rate and then we're gonna hang it there. We need a 4% Fed rate. Now they're talking about 4.25%, 4.5% on the Fed rate, that is. So he's been announcing these little tweets to Nick Timrose, who is with the Wall Street Journal. If you're a Twitter person, follow Nick. Nick is somehow designated as the guy who gets the inside scoop. For whatever reason, doesn't matter why he was chosen, but he was chosen because the Fed came out saying that if I can give some advance notice, the market doesn't get as nuts right after we talk, because the market expects it. Because remember, the markets don't move on action, they move on the expectation of action. We've already baked in so much of what we're gonna see. So Nick is now the inside scoop. So he leaked it out, then we're gonna see 75 bips. And he did that even before the market took it on. And 75 bips it is. In fact, some people are saying we could see as much as 1%. So then the consumer price index came out, which Patty was talking about. And really the shocker was the month over month. The core month over month went up 0.6%. Shelter is finally catching up. It has been almost non-existent on the previous CPI indexes. So the CPI is finally recognizing that the cost of renting is going up. Hello. We're all feeling it, right? So finally, that's in the metrics. So now the month over month went up because of food and shelter. So now everybody agrees. So based on there's a Fed tool, watch tool, and so there is no 0.5 even on the watch tool anymore. It's 0.75 or 1%, and then they do have the 2 more meetings, and there's even an expectation that it'll be 0.75 again at the next one, and then 0.5 or 0.25 at the next one. The goal is we're going to take the Fed rate up to 4 to 4.5. What does that really mean to you? It's not the 30-year fixed. It's the HELOCs. It's the credit card interest rates, right? It's the auto loans. Stop spending for just a minute, right? Because the cost of spending is going to cost you more. Everybody's going for HELOCs right now because the cash out refinances don't make sense because the interest rates are 6.25. So you're doing the HELOCs, but those interest rates are going to be 8, 8.5. Could be, depending on the bank, depending on your credit score, what your LTV is. So you have to balance the budget on that HELOC payment, even if it is interest only. Caution your clients. Don't tell them to go get a HELOC to go buy more properties or to pay off debt. Do it strategically. I'm not saying don't do it. Do it strategically. There's absolutely a strategic advantage to consolidating debt, to right sizing, and then taking advantage of opportunities, because opportunities always exist during recessions. Opportunities always exist during recessions. Are you ready to take advantage of them and educate your clients on that? So the whole purpose of Powell raising the Fed rate is to slow down. And we already talked about this. The GDP is 70% of it is the consumer spending. So we're trying to get the consumers to spend less, because everybody's like, well, if the Fed rate goes up, does the 30-year fixed rate go up? The 30-year fixed rate is based on inflation, not on the Fed rate. The short term, the ARM rates are based on the Fed rate. But the 30-year fixed is based on long-term. Think Social Security benefits. If I have Social Security income long-term, does that same income, fixed income, buy me more or less? That's how you're thinking about the long-term 30-year fixed. Employment is still record low. We talked about that. When we're seeing job increases like we're seeing, and we're seeing unemployment as low as we are, the Fed has turned into a single mandate. So they were dual mandate. And I joke about this all the time. They only have 2 jobs. I mean, come on, get it right. But now they only have 1 job. Come on, get it right, right? So the Fed's got 1 job right now because they've washed employment to the side, because employment is fine. There's not enough people for the jobs that we're even looking for. In fact, jobless claims just came out this morning and fell for the 5th straight week to a 3-month low. jobless claims. People aren't going on unemployment because even if they get laid off, because some companies are laying off, they're going out and just getting another job. And we've got more people coming into the workforce. JOLTS has a jobs opening report. We're back up to 11.2 million job openings. Sometimes it doesn't feel like that. I know my kids were I have young adult children and they were just looking for jobs. One of them he was talking about how hard it was. So it's interesting, the boots on the ground versus the numbers, sometimes how they're different. But there's 11.2 million job openings and that number's up. So employment, check, we're good. Credit card up to another record, right? 1.13 trillion in credit card debt. Now, as incomes also go up, you could say that home prices and credit card debt is still within reason, and those people can afford it. And you're seeing that, especially because we're talking about the million plus buyer has money. The first time home buyer is struggling to odds off, but the million plus buyer has a lot of money. Please don't give up on the first time home buyers. They're trying really hard. They need our help now more than ever. But if you got a couple $1 million buyers in there, it's probably going to sustain you while the first time home buyers are struggling to get in, right? Because they have money and they're spending it. So when will this peak? So if you go back and you look at the core inflation, CPI inflation, we've got another month of this. So when we look at year over year, everything is comparative. Everything Megan does, everything I do. We're looking at month over month and year over year. We're comparing even back to 2019. So when I'm comparing, I've got another really low CPI number a year ago that we're going to have to, that one washes off and the new one comes in, right? So it's a year over year comparison. That number being low, our CPI could go up again next month. Then we've got this massive uptick where we could actually see those CPI numbers start coming back down again in October. But we could see this continued volatility and continued interest rates going up because inflation is high. So homeowners are good. Homeowners are good. I want to run through a couple of reports that just came out, appreciation and home ownership equity, because these are massive and they need to continue going out on social media. We need to continue letting people know that homeowners are nowhere near in a recession, right? These are the people that got in a couple of years ago and you're thinking, okay, but dang it, I didn't. Home ownership is still going to go up. Home prices are still going to go up. We have to help as many people get out of rent and into ownership, because this is the opportunity to build real wealth. Home ownership is up, appreciation was up nationwide. Now this is July, so it's a little bit dated. Appreciation in Denver still 14.3%. That's still too high. Our average, our historic average year over year price growth is 6%. Average and median is a little bit different than appreciation. This core logic is actually looking at the individual homes every time that they are sold. Right? So appreciation is still strong. Home price index is up 153% in the Denver metro. Those who have homes have a lot of equity, a lot of stability, and a lot of financial security for many years to come. Home ownership equity nationwide. So they actually showed out that Denver is up $76,000. So still a lot of people made more money in their homes than on their jobs. This is the job we have. Right? This is the job that we have. It's home ownership. Our job isn't a transactional job. Our job is a wealth transitional job. We have to look at it like that. This isn't about just helping make a sale happen or helping somebody sell and then buy, or buy before they sell. That's the trick, right? This is about building real wealth. Homeowners' equity is double it was in 2006. We are so cushioned against a recession. Everybody that's talking about losing home values isn't really looking at the numbers. The numbers have us so cushioned where the number of homes, well, we're actually going to show that. The number of mortgages in delinquency and foreclosure, negative equity, super low. In fact, Black Knight just put out the tappable equity report showing that now our average loan to value in the United States is 42%. It's the lowest it's ever been. 42%. This tappable equity is leaving 20% in the home. I can still tap out the other 80%, and it is record high. I'm not telling everybody to go get it out. I'm telling you, this is the security and stability that homeowners have that renters don't. This is our job. Negative equity is down. It is incredibly low. We're sitting at 1.4% in the state of Colorado. We just simply, even if we have some homes go into foreclosure or short sale, it's not going to be enough to make a move on the entire market. In order to have a recessionary effect or impact on the housing market and have a housing crash, you have to have a wide standing depression of home values. We're not going to have that. Colorado's delinquency is 1.8%. Our foreclosure rate is 0.1%. Again, continues to speak to the consistency of the stability of the housing market. So gather up these facts, right? Have them in your arsenal. Like I was listening to a speaker and he said, you always want to have like 3 questions, 5 facts. Like if somebody catches you in an elevator, like what's going on with the housing market? Like the first thing I wouldn't say is like, oh my God, have you seen headlines? We're in a recession. Oh my gosh, homeowners are so incredibly strong right now. What would it take to get you into homeownership? I want to protect your financial future and multi-generational wealth. What would it take to get you into homeownership? What does that look like today? If you're worried about home prices dropping, Black Knight also put out this report and they said, if we see a 15% drop in price, we're still going to be less than 4% in delinquency status. It's the people that bought in 2022 and the latter half of 2021 that paid $50,000 to $100,000 to $150,000 over asking that could go negative in their equity. But here's the secret: just don't sell. Just don't sell. You're only negative if you sell and you capture that. Stocks might go down, but I can sell them at the bottom and they come back up again. I can still have a gain. I can recover that gain. But if I sell at the bottom, I realize the loss. So just don't sell. Yes, I get it. People overpaid for their homes in the second half of last year, the first half of this year. They got into a home. I'm not going to look back at that and say I should have, would have, could have done it different. They got into a home, hopefully a home that they love, not the one next door to the grocery store. Home prices continue to go up during recessions. We've seen it recession after recession after recession. Home prices go up during recessions. So with that, it's because interest rates come down. If we see interest rates come down and new listings are low, we will see another run up in home prices. We have to let our first-time home buyers know that they're not out of the clear yet, because the long-term wealth gain is where real estate is, right? Because just holding onto a home and allowing principal reduction and slow appreciation provides a kind of wealth gain that stocks can't do because of the power of leverage. I don't have enough money to put in the stocks that 5 years later, I'm going to have a net worth of $150,000 more than that, right? You have to invest quite a bit to get there, but with the power of leverage, I can put 3 to 5% down and I can get there. That's game changing. So really quickly, OneTrust, and I want to go back to what I said before. I was at Fairway for 9 years. If you're working with any Fairway loan officers, they are fantastic. I am not going to say a negative thing about Fairway Mortgage because it's not about that. It really isn't. I joke about some things back and forth, but it's not about that. Vanna White was quoted as saying, it's not where your name is, it's what it represents. The Rueth team represents something different, regardless of if it's with Fairway Mortgage or OneTrust. And I just wanted to stand behind and say that what we're opening up is the same customer service, the same quick closings, the same earnest money guarantees, but more product availability, right? Nobody can change the fact that interest rates are 6.25. I'm sorry. Like I can't come in and go, but I got 4 today. I don't have that. I'm just not even gonna lie. But what we have is nationwide access and we have more products. So I wanted to throw this up here, and it's a lot, but it just simply says that we have what our clients in a changing market need, right? Because in a changing market, we can't just do the thing that we've been doing over the last 3 years. We have to do it differently. How can I help this buyer realize an investment opportunity that maybe they can split and sell off? Or maybe they can rent out part of it and live in the other part. Maybe they can do the house tax. Maybe they can look at real estate differently, because right now, if I just buy a single family home and I convert it to a rental, it is not going to cash flow. So do I stop working with investors or do I help investors see a different avenue? That's what we're doing with the new product line. Not only do I have ownership, so I have say in where we go with this, but we have not only the 2-1 buy downs, we have the 3-2-1 buy downs. Something that we need to be talking about. Sellers need to be buying down the rates right now. We have the VA construction loan, the fix and flip loans, land to construction, one-time close, two-time closes, all of those things. We can do commercial, so 5 units and over, and we do all the non-QM in the house, and we have SBA loans. This is the kind of access that we need in today's market. Be thinking about your business. You're not a real estate agent. You are a guide to financial stability and security through real estate. How do you operate? What products do you offer? What services do you have? What knowledge do you share? And who are you right now in space, in a time when clients need you most? Because don't just be a real estate agent that puts up the for sales, the just sold, that thing, right? It's really kind of salt in the wounds right now. It's about how can I help you? If not today, when? How do we set up a plan for 2 months from now, for 3 months from now, for 12 months from now? If not now, when? And if not the easy route, how? Because I'm here with you. We have to change our story the same way I changed mine, because we have to be able to offer more in a time such as this. And then, of course, for especially for first-time homebuyers, but really anybody. So Fannie and Freddie, just to let you know, Fannie and Freddie announced their new loan limits in November. They haven't announced them yet. Quicken did this first. They're chomping at the bit to win as much business as they could. So they increased the conventional loan limits, and every lender who's doing this, Fairway's doing it, OneTrust is doing it, Movement's doing it, Rocket started it. Everybody's holding on to them until they can sell them in January. So it's expensive for the lenders, but they know they want to support clients, because right now the thing that's hurting people most is home affordability. So how do we get in front of this and offer more products at easier access to our clients? And one of the ways is increasing and this isn't even a high balance, guys. In Denver, we have a high balance conforming loan limit that hasn't even been rolled out yet. That's coming and it's probably going to be a lot closer to 800, which blows my mind. So that's a wrap for this week's Market Trends with Megan.sisk.aller, with Patty Silverstein. You guys are amazing. For the people that were on Zoom and on Facebook, we'll figure out the first couple minutes. We'll get Miss Megan to do a selfie and get you clued in. How are you guys feeling? Thank you guys so much for coming out. We'll get something set up for the goal setting. You guys are the troopers. You got the full presentation on audio, plus Patty. Thank you guys. It's always a pleasure. And sign up for the next big thing.